Money movers and market watchers, hold on to your coffee, because we've got a financial earthquake shaking Washington right now. The U.S. Treasury Secretary has just gone public, yes, public, demanding that the Federal Reserve slash interest rates. And not a polite little trim, we're talking a deep cut. Now, why would they risk rattling the markets like this? Is it really about helping families? Or is there something else, something more strategic going on here? Stick with me, because in the next few minutes, you'll see why this single move could impact your investments, your loans, the dollar in your wallet, and maybe even the price of your morning coffee. Picture it. Breaking news banners everywhere, traders leaning forward in their chairs, algorithms firing off trades before you even blink. The second this hit, the bond market twitched, yields dipped, a signal that investors are bracing for easier money. The dollar? It wobbled. Not enough to collapse, but enough for international markets to raise an eyebrow. And the stock market. Well, some sectors popped, others hesitated. Why? Because this isn't just economic policy. This is a political and financial power play. And here's the part no one's talking about. This move puts the Fed in a position they absolutely hate, the public spotlight, with pressure coming from the very top. Let's peel back the curtain. Yes, on paper, lower rates mean cheaper borrowing. Good for home buyers, good for businesses, good for anyone with debt. That's the friendly headline. But if we zoom out, the timing looks suspicious. Election season's right around the corner, and history tells us that pre-election rate cuts can give the economy a quick shot of adrenaline, lower unemployment numbers, happier consumers, a stock market that looks alive again. Now, here's a thought. What if this isn't about long-term health at all, but about making the next few months look shiny? The kind of shiny that voters notice. In other words, are we watching economic policy being used as political marketing? You tell me in the comments. Now let's put ourselves in Jerome Powell's seat for a minute. Imagine you've been raising rates for over a year, trying to beat back inflation that's been eating into everyone's paycheck. You've made progress, sure, but it's still stubborn, still higher than you want. And then the Treasury walks in and says, hey, how about you reverse all that work and cut rates right now? Here's the risk. Cut too soon and we could see prices take off again. Groceries, gas, rent, all heading north. And once inflation starts moving, it's like trying to put toothpaste back in the tube. So Powell's team has to choose. Hold their ground and risk slowing the economy further, or cave to pressure and risk inflation roaring back. Either way, someone's going to be furious, whether it's Wall Street, Washington, or Main Street. Okay, enough theory. Let's talk about you. Got a mortgage or thinking about one? Lower rates could mean smaller monthly payments. Carrying credit card debt? You might see your interest rates drop a bit. Have money sitting in a high-yield savings account? Bad news, those juicy rates could dry up fast. Playing the stock market? A rally might be coming, but be careful. These kinds of rallies are like sugar highs. Sweet at first, then the crash comes hard. And here's the sneaky part. A weaker dollar from rate cuts could mean higher prices on imports. Translation. The stuff you buy, from electronics to clothes to groceries, could quietly start costing more. All right, let's run the tape. Scenario 1. The Fed folds. They cut rates big, the economy gets a short-term boost, stocks go wild. But if inflation hangs around, we're staring at stagflation. Low growth, high prices. Worst combo possible. Scenario 2. The Fed stands its ground. No cuts, markets pout, maybe even drop. But inflation keeps cooling, and we could see steadier growth later. Here's the kicker. Smart investors aren't betting on just one outcome. They're preparing for both. So what's the takeaway? This isn't just some dry policy debate. This is a tug-of-war for control of the U.S. economy. The Treasury's pulling for speed, the Fed's holding the brakes, and your money's the rope in the middle. I want to know where you stand. Should the Fed cut rates now, or should they stay the course? And more importantly, how are you positioning yourself for either outcome? Drop your strategy in the comments. You might help someone else watching this make a smarter move. If you found this breakdown valuable, hit that like button, Subscribe for more high-stakes market insights and turn on notifications so you never miss when the next big move drops.